Good morning, Emily.
Hi, Dan.
Not a good morning?
I'm a student again. There are no good mornings.
Fair enough. Although, having just graduated, I will say that one day it's all going to be worth it. But I assume that that's going to be relevant for this week's topics.
Yes, we're talking about student loans and whole life insurance and target date funds.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, just a panoply of different subjects here with no relation whatsoever. I look forward to our incredibly smooth transitions.
Yeah, you know it. We have that to look forward to as always.
Always. All right, well, then what do we want to start with? Is it student loans?
Of course, that's on my mind and in the news and on a lot of people's minds, at least in my peer group. So I thought it was a pretty good topic to go over here with you.
Okay, well, hit me. What do we want to understand about student loans?
Sure. Okay, let's talk about the types first. There's the obvious direct subsidized and there's the unsubsidized ones. Subsidized being where the government pays the interest while you're in school and during that grace period of 6 months after graduating, and if there's a period of deferment. Whereas unsubsidized, the interest begins accumulating immediately, even while you're in school.
Sure. So, student loans are what they are. They're interesting as I'm going to call them a security, even though they're not really securitized that much in that particular way. But they're sort of interesting as a security because almost all other lending is either completely unsecured or secured. Meaning, if it's secured, it's on your like a mortgage on your house. It's a car loan. Like there's a thing you can sell to get your money back on. And conversely, it's unsecured is like your credit card or just like a personal loan in your name where you make a personal guarantee that you're going to pay it back. But if you go bankrupt, there's no way for the bank or the institution to recover against it. Student loans are sort of fascinating because it's debt secured against your human capital, meaning your earnings capacity and ability to just make a better living because of that education that was paid for with the loan. So it's an interesting world. Obviously, it's a big problem in the United States. We have over $1 trillion in student loan debt accrued. But the various sort of levers that you push and pull and how you actually pay for college are sort of a fascinating subject.
Is that something you encounter a lot with people who already have student loans? You have a bit more experience than I do talking to people that already have these and have had them for several years. So I'd be curious on your perspective here.
So the subsidized thing and the unsubsidized thing is interesting because first of all, these are needs based. So everybody who's going to college typically is going to fill out the FAFSA, where you fill in your personal financial information about income and assets for your parents, right? And essentially, what you're doing there is completing sort of some hoop jumping for eligibility for certain state benefits, just general tax credits and so on that go to schools to help subsidize the cost of college. That's why there's in-state and out-of-state tuition. But then also to determine kind of where you fall on the spectrum of merit based aid based on financial need. So, not like, are your grades good or something like that, but just like, hey, is your family well off? They're expected to pay for a lot of your college, or are you in a lower economic status? And so, even before you get to things like subsidized loans, you then have eligibility for certain scholarships, Pell Grants, like literal free money versus I think financial aid is a funny word because financial aid in most contexts for colleges just means how you borrow money to come to the school. But one of the tiers of merit based or needs based eligibility is going to be for a direct subsidized Stafford loan or an unsubsidized Stafford loan. And these are going to have both preferable interest rates, but specifically with the subsidized version, the interest is essentially paid for while you're in school, whereas for the unsubsidized version, interest is accumulating while you're in college. Now, there's a conversation here to be made about making at least interest-only payments to keep you from accruing debt in school, but this really depends on how expensive it is, whether you can afford it, and what your career trajectory is for after graduation. But that's sort of the first stop is just going to be, hey, Stafford loans are going to be kind of our not free money necessarily, but our most preferable borrowing form for at least undergrad and possibly up into graduate school at certain points.
Sure. Well, what about private loans then? That's a whole different branch of all this.
Well, and there we're even sort of skipping over the plus loan category, which are going to be sort of parentally signed loans, where it's it's being co-signed essentially the same way for like a lot of people's first apartments. Your parents have to co-sign to make sure you're going to pay rent. So plus loans are sort of the step in between because once you get into private loans, interest is going to start pretty much instantaneously, and all this special stuff around like forgiveness and deferment and forbearance and all the things that apply to federal loans are much trickier. I think it's not super common. Well, okay, it's $1 trillion industry. It's common enough, but relatively to the other types of loans, private loans are going to be sort of the loans of last resort for a lot of borrowers looking to go to college. And I think more people get themselves in trouble with those, not for going to college, but when they actually are out of school and they start getting mailers from these various companies saying you can consolidate your student debt at a lower interest rate. And the problem that arises with that is that you often will lose your eligibility for forgiveness or consolidation through that.
Okay, so is it, I mean, it's a broad statement, but not a good idea to consolidate your loans then? Or ever, is there ever a time where, yes, you definitely should do that, even though they then become private loans?
I think it really depends on your career trajectory and your earnings trajectory. And the fundamental answer to the question is going to be is the intent that one day your loans will just go away, you'll be forgiven for some reason? Or is the intent that you're actually going to get them paid off, right? You're on an income career trajectory where you're always going to end up in a result where you're just going to get down to a balance of zero. In that particular case, then it makes sense to do consolidation and pay less interest and so on. But if you're going for public service loan forgiveness, where you work for the government or certain qualified nonprofits for at least 120 months and your loans just magically go away, or you're under payee or repayee systems where after a certain amount of time, typically 20 or 25 years, your loans are then forgiven after that amount of time, but it's taxably forgiven. So then there's a bit of a tax bill attached to it. Then in those cases, it makes more sense to say, hey, if I've got such a student loan burden that I'm never going to be able to afford to pay it off, we're better off going for forgiveness than we are for trying to get the interest rates down. But if our loans were probably going to be paid off in 5 to 10 years anyway, because we have a good paying job or we didn't borrow that much, then that lower interest consolidation could make a lot of sense.
Sure, lots of things to consider. What if you're not really sure where your career trajectory is going? Just better to leave them alone and try to figure things out before you make any big moves?
I think it's going to be better to stay on the federal side or sort of on the non-private side, non-consolidated side there because of the hedge there, because we can only go one direction. We can't go from private to federal, generally speaking, but we can go from federal to private. There's another category here, which is some states have state student lending programs, and then that's a whole extra tranche of complexity. But otherwise, generally speaking, until I know where I'm going, respecting that, of course, life changes and stuff happens, until I'm very confident, I want to stay on the forgivable side of things than just trying to get to the interest paid off faster version of things, bearing in mind that that might cost you more than if you'd figured it out sooner and done the consolidation and cut your interest rates. But that's sort of a premium you're paying for the flexibility.
Sure. Okay, so let's say that you've figured all that out, you know what you're doing, and you're slowly paying down your student loans or waiting out the clock, whichever one you're doing. How much do you prioritize then at that point, building your emergency fund and investing for retirement, these other things you should be doing versus trying to pay down these generally high interest student loans early?
Well, and high interest is interesting here because they're higher than a mortgage, but they're not like credit card rates, typically speaking. But they do sort of live in the limbo land of about equivalent to investment returns, where often your rate might be like 6.5, 7.5, 8%, which is right in the target area for a lot of sort of long-term annual returns for investing. I think actually a good companion to this question would be to listen to the mortgage payoff question Daniel asked last week. We went really into a lot of depth about investment rates of returns after tax considerations, probability, and so on. But succinctly here, the answer really just becomes a question of time horizon and expected cost versus expected return. For example, if I'm trying to pay off a 10-year loan extra fast, that is a short enough time horizon where the certainty might be at a premium. But if I'm comparing that to my lifetime investment returns, where I have 50-year time horizon or 60-year time horizon, then the compounding factors of that extra 40 or 50 years are going to outweigh the 10-year time horizon, because debt functionally exists in sort of a limited game scope, right? There's a termination point at which, all things being equal, the debt should be paid off or forgiven otherwise. And in turn, right, you have this unlimited game, aka your life expectancy, strategy for investing. And so, rate of return wise, it can make a lot of sense to pay off loans early if the interest rates are too high. But lifetime wealth accumulation wise, it may make more sense to stay invested, either if the rates of return are equal to or greater than net of the tax ramifications, but also based on the time horizon. So, for example, certain graduate loans don't forgive until 25 years. Well, 25 years is a pretty long time relative to the, let's say the retirement timeline of, let's say, 30 to 40 years after undergrad or grad school. So then it just becomes a question really of, at the end of the day, are we trying to optimize for cash flow? Are we trying to optimize for lifetime wealth building? Are we trying to optimize for psychological security, right? I'm debt free, thank God. So that's sort of the question that has to be asked in the context here. So there's not just a mathematical answer because it depends on how we define the alternative to paying off the debt and what we're intending to do with that optimization.
Sure. Hmm. Well, as always, a lot to think about there. What about you do hear about these scams from companies that will send you mailers or emails or whatever and say, we'll erase your debt for a certain fee, or we can help you with this and that, but it's not necessarily actually a good program or anything to do. It's just a scam. Is there a pretty high rate of that or not necessarily?
I don't hear about a lot of that, but I'm going to cite my sort of perspective bias here. Most of the people we talk to as clients are well-to-do, affluent couples or individuals who are sort of past the phase where that would be a problem for them. I think the people who are more likely to be targeted with that are their children, right, or their adult children. I don't see a lot of that. I'm sure it happens out there, and you see the same thing for like IRS debt and just debt consolidation and credit clinics and all sorts of things there. I would just be really skeptical. I think there's always an element of if it's too good to be true that you should be applying to something like that. And I'm also always very mindful of just the impetus for the information, which is, did I go looking for some magic pill to solve my problem here, or did somebody try to sell me the magic pill? Was this from a mailer, from an ad, from a pop up, from an email, or was I looking for it? Because when it comes to you, you know that there's just sort of a rational, there's somebody on the other side of that send out trying to make money from sending it to you. And conversely, if you're looking for it, that could still be the case, but you are doing the research, you're driving that versus sort of being sold a bill of goods in the mail or online or from a telephone spammer or whatever it is.
All right. Well, is there anything else people should think about or look at in this context?
I think a really phenomenal resource on this is a book called How to Pay for College by Ann Garcia. I think anybody who has kids at all, or who has kids in college, or kids who just got out of college, should really go take a look at that book. I'm sure you can get it for like 15 or 20 bucks on Amazon, but it's a really, really good resource on this. I think Ann is probably one of the best speakers on this subject as a whole. And I think that book is just a really terrific resource for anybody who's trying to figure out, really, at the end of the day, how have you paid, or how do you pay for a very expensive thing we call education.
Hmm. Maybe I should add that to my reading list now that I'm back in school. All right, here's the smooth transition to topic number 2, Dan. Let's talk whole life policies.
Oh boy, you could not bring me more joy and excitement if you tried. Really, I'm so excited to talk about permanent life insurance. Emily, hit me up. What can we possibly shout from the rooftops and cheer for here?
Well, I know you love them so much, but let's first explain to people what is a whole life policy, because we run into that a ton too, where people have one and they don't even know what it is. It's very common.
So, whole life policies are the most traditional form of what we would call a permanent life insurance policy. So, big umbrella term, permanent life insurance. Whole life is a subcategory of that. A whole life policy is essentially an insurance contract between you and this life insurance company for a stated death benefit, which may remain fixed or increase or decrease, although decreasing is pretty rare. That essentially, mathematically, the basic idea here is, you buy this in your 20s, 30s, 40s, whatever it is, and then there's a death benefit, and they're going to make you pay enough in premiums into the policy on a going basis that by the time you reached essentially 100, you would have put in enough premiums and earned enough interest on it to equate to the death benefit. And so if you lift your life expectancy, you've just saved up money in an efficient way. But if you happen to die before your life expectancy, then the insurance component kicks in, and now you have this death benefit to take care of your friends and family and kids, whoever else was supposed to be a beneficiary of it.
Hmm. Okay, so on a surface level, it sounds like insurance, pros and cons, depends if the bad thing happens or not. Why do you hate them so much? What's the problem?
Hate's a strong word, Emily. I don't hate
You feel
them.
strongly about them.
I do feel strongly about them. So, for anybody who understands a little bit more about permanent life insurance and the arguments between whole and universal life, my dislike for whole life is not an either or sort of dislike. My dislike tends to be that whole life is a very expensive form of insurance. And you can argue, well, it's more or less expensive than the alternatives. Whatever, it's very expensive, and generally speaking, I find that most people who have whole life insurance have an inadequate amount of life insurance, but are paying a lot for it. So, to give you an example, it's very common for us to talk to clients who bought a policy in like the 80s or the 90s, the early 2000s, and the death benefit is like $50,000 or $100,000, and they've been spending, $1,000 a year on it or something like that. And now they're 25, 30, 40 years older, and we're sort of shoulder shrugging, going like, well, great, you've got $50,000 of life insurance that might pay to bury you and maybe give your family some time off, and it's not going to do much more for you. And in the meantime, these same people, their whole careers, thank goodness they haven't died, right? We're having this conversation with them now, but this whole time throughout their careers, they probably needed hundreds of thousands or millions of dollars in life insurance to replace their wages and the opportunity costs that come with losing their earnings. And they've been underinsured the whole time. And so the problem that arises here is that you're often paying something like 10 to 20 times as much for whole life insurance as you would for just a nice 20-year or 30-year term policy for substantially more coverage. That's just my basic objection. It's not that whole life is a bad tool for any particular reason. It's that I most often see an inadequate amount of insurance sold to people who need more life insurance, and they're sort of sold on these squishy, questionable benefits or the living benefits of life insurance, rather than just protecting the core risk that life insurance is intended to protect against, which is the loss of your income from your departing or your passing.
Okay. Well, what about that cash value component that they always tell you about when they're selling you the whole life insurance? That sounds oh so very tantalizing.
Well, and this is where the argument comes in. The phrase that I was taught when I still had my life insurance license was you're supposed to ask the client or the prospect, do you want to rent life insurance or do you want to own life insurance? Because term, you're just renting your coverage, and then when you're done renting, you have nothing to show for it. But if you buy a permanent policy, then you own it and you've got equity and value. The challenge is that most life insurance policies have a really shitty rate of return. And so this is where a popular phrase that came up in the 80s, which was buy term and invest the difference. And this is where you can get into like hardcore insurance nerd math. There's plenty of good calculations that can show that net of the taxes and this and that and so on, that whole life might work better over a really long period of time than the investing. And with the investing, yes, you've got life insurance and the investments, but you'd have more if you had the life insurance instead or invested more in the life insurance. It's this weird thing where like you can essentially, it's sort of like anybody can make an equation that makes them look good, or sort of the old expression about like there's lies, damn lies, and statistics. Like anybody can come up with a model that shows that they're right in this argument. So I don't really put a lot of weight on that. My greater challenge with something like the cash value is, okay, remember how I described it. The whole idea is that you're going to accumulate value in this policy, which is the cash value, that reaches the death benefit by the time you pass away. So then, if you want to use that cash value for something else, you are fundamentally undermining the policy. Now, there's ways around that. You can, for example, borrow against the policies. Rather than taking the cash value out of it, you can take out a loan. Well, okay, but you could have always taken a loan out against your house or taken a personal loan or used a credit card. So, like, what are we solving for here? You can, convert the policy from a permanent life insurance policy into something like a long-term care policy or an annuity. So there's some benefit here where you could say, well, we can, maybe our life insurance need has gone away, and now we would be better off with long-term care insurance or better off with more retirement income. So there's like little utility cases like that. But the problem is that functionally, this thing is very expensive at the outset. Like for the first 5 to 10 years that you put money into a whole life policy, you essentially are not going to get your money back unless you overfund it, and then you're just getting the overfunding back, which is a separate conversation. And then functionally, longer term, it's a suboptimal way of getting long-term care insurance. It's a suboptimal way of building up investment value to put into an annuity. And at the end of the day, like it's a hybrid solution. And like many hybrid solutions, it's not the most optimal solution for any of the specific sub solutions that the hybrid provides for.
Okay. So there's never really a scenario where it's the best solution.
Well, and that even is not necessarily true. There's cases where, for example, you can have some really interesting advanced estate planning stuff with whole life insurance. And again, this just comes back to my grievance. It's not that whole life insurance is a bad product. It's that the vast majority of the time that I see it in use, it's being used to solve the wrong problems. And the problem that it's really solving is I get a bigger commission when I sell whole life than when I sell term life. Like that's almost always what's happening. It's very frustrating. But there's cases where, for example, you can do an irrevocable life insurance trust. Let's say your family owns a lot of acreage, a big farm, out in the Midwest or something, and it's worth millions and millions and millions of dollars. Well, if you don't have a source of liquidity one day when your parents, whoever passes away and leaves behind, let's say this $30 million farmland, you're going to have an enormous multi-million-dollar tax bill attached to that. And if you don't have a source of liquidity, like a life insurance policy to pay the taxes, then you're going to get forced into liquidating some of the property or selling the property to pay the taxes that are due upon the passing. So you can use something like an irrevocable life insurance trust to buy life insurance against yourself and then hold it away from you for a number of years to get it out of your estate in such a way that then when you pass away, your heirs can have the cash to pay the tax bill and keep all the land intact. Like there's really specific niche cases like that where it's a useful tool. It's just almost never being used that way, like just as a ratio of the number of whole life policies. I have no data for this, but I'm just going to posit probably something like 95% of whole life policies are being sold to individuals or couples who need hundreds of thousands or millions of dollars of insurance to protect each other and protect their kids. And instead, they're getting a lot less whole life insurance with the purpose of just selling the more expensive version of the policy to help an agent meet their quota. And I hate to be judgy about it that way, but that's just, again, anecdotal, my personal experience and perspective. That is almost always what's happening. It's very frustrating in practice.
Is this the type of thing? You and I talked about this, I think, a year ago when we were talking about filial responsibility. And like, if we use me as an example, my father lives in a state that's filial responsibility, where I would potentially be on the hook to pay for his care if the state stepped in. Would that be a scenario where theoretically I could take out a whole life policy on him to be able to cover for that, like you talked about, or I would be better off just getting a term policy for that too?
Well, the big thing that the permanent policy protects you from is that longevity risk, because the risk you take with a term policy is that your dad or anybody else is going to outlive the benefit. Let's say you buy a 30-year policy on your dad. I don't know how old your dad is. I'm going to just guess somewhere in his 50s. But let's say we buy a 30-year policy and he's 55. Well, we're really hoping he doesn't live past 85, because if he lives past 85, we got nothing. And so that's sort of the challenge in this, is that permanent does have one particular important feature, which is that it doesn't expire based on age. And so from that basic mechanical structure, the idea here is that it does help solve for that. But to your particular example of like filial responsibility for long-term care costs, my argument would be, it's a better solution, just getting long-term care insurance. Let's get the insurance that actually solves for the specific risk we're trying to insure against. But you could argue that, okay, he'll go into care and the state will send you a bill one day, and when he's passed away, you'll have the whole life insurance to not only pay the bill, but maybe you'll have some money left over. Like, there are different approaches you can sort of play the it depends game with it. I just fundamentally come down to a place where, at the end of the day, whole life insurance is a great tool for certain problems. It's just hard to find the majority of cases being the appropriate solution problem combination.
Sure. Okay. Well, let's say you have one. How do you get out of it? Do you just cancel it and deal with the fact that you maybe paid in for a few years and you're not going to get that back if it's in that first 5 to 10 years, and move on?
So this is very much a, look at your contract, understand what it is. So when you look at your statements for a whole life policy, you will see a cash value or an accumulation value on it, and then you'll also see a surrender value. Surrender value is typically less than the accumulation value when you're in that first 5-10 year period. Some periods are longer, but essentially they're just, there's a schedule. And the trick is, when you bought the policy, the schedule is in your contract. If you go look in your contract or at the original sales illustration, you'll find the schedule somewhere. There's a point at which these surrender costs go away. The trick is that often you're going to have to keep paying into the policy for years and years and years, greater than the amount you might get if you just cut the policy short. So it really depends. But if you're still in surrender, you just have to make a decision about, at the end of the day, like, we're going to cut my losses here. I think the first thing you do there is say, okay, if I lose this policy, do I have enough life insurance elsewhere for my spouse, for my kids, for my family, for my needs? And if not, go get that first, right? Don't cancel your insurance and then have a gap of uninsured time and then get more insurance or hope you can get more insurance. Try to make sure you're covered across the board. The second thing then would be, let's say you're past surrender or you're well into surrender and there's actually a decent amount of cash value, 20, 30, $40,000. Well, we could do an asset-based long-term care policy where we're just giving the insurance company a chunk of change and they're going to give us a essentially sort of a long-term care death benefit sort of thing where it's going to be more valuable to us later on, but we don't have to keep paying for it over time. We're just making an early investment to pay for long-term care. We could roll it into an annuity of a variety of types, whether it's a VA, indexed annuity, a SPIA, or a deferred fixed annuity. It just depends on what your needs are. So you can cash it out and just get the money out of it and go invest it, but I would explore the various options and other risks that are present for you before you just say, I'm going to file the surrender paperwork and take what money they send me. Because also that surrender could be a taxable event depending on how much accumulation there is. So then there's also tax ramifications to this as well.
That sounds really fun for everyone out there who's listening and starting to worry about the whole life policy they might have.
I'm not trying to scare anybody here. And if you're a client, we'll have already discussed whether your whole life policy does or doesn't make any sort of sense. But it's just one of those things where unless there's a really particular risk or strategy, I think your default setting should be, why would I buy whole life insurance? Just 99% of the time you don't need it. But if there's a specific thing, like we're trying to create an ILIT, that irrevocable life insurance trust, or, hey, I am really concerned about the costs of my estate one day when I pass away, or maybe you're a retiree and you're like, look, I want to spend all my money, but I do want to leave something for my kids. So I'll buy a policy to leave something for my kids, and then I'm going to spend the rest of my money. Like, I can see certain scenarios or certain really specific outcomes we're trying to solve for. But if we're trying to solve for just like, hey, I've got a partner, or kids, or whatever, and I want to leave something for them to make sure they're taken care of when I pass away, the probability that a whole life insurance policy is the correct solution for that particular problem is practically zero.
Okay, that answers all of my whole life questions. I had to make sure. Now, here's my transition to the final and third topic, which is target date funds. Completely different.
Okay, target date funds. They sure are funds that target a date.
Right, but what are they? It's in the name, but again, sometimes people don't realize necessarily what a target date fund is.
Yeah, so a target date fund in almost all cases is going to be what we'd call a fund of funds, meaning that it's going to be offered by a company like Vanguard or American Funds or Fidelity, and essentially it is going to be a composition of other funds from that company. So let's say the Vanguard S&P 500 index and the total stock market index, the international index, and so on. And they're going to have a series. They're going to have something like the Vanguard Target Retirement 2020 Fund, 2025 Fund, 2030 Fund, 2035 Fund. And these are just years. And essentially the fund is targeting that you will retire around that particular year. And so it goes from high risk, high reward. So if we look at like the Vanguard 2065 target date fund, very aggressive, very equity heavy, et cetera. And as we get closer to the year 2065, it's steadily going to start tapering down its level of risk until by the time you're at 2065 and you're presumably retiring around that time, it's a much more appropriate portfolio for a retiree. So it's essentially a one-stop shop type of solution for somebody who wants to put their retirement savings and investment selection on autopilot.
Okay, so that seems simple enough. You just pick the year you think you're going to need the money, usually your retirement year, and put it in there and forget about it. Is that a big part of why so many companies have them like in their 401k as an option, is because they're just so easy to do for people who maybe aren't very interested in choosing investments?
That's part of it. Retirement plans like 401ks also have to establish a qualified default investment, essentially selection, or what's called a QDIA. And that can essentially be either a money market stable value type of option where it's really just not going to lose any value, or it can be a managed portfolio. So sometimes companies have like custom portfolio managers that like have an aggressive and a conservative and a moderate and so on portfolio, and it'll just sort of default you into one of those. Or it can default you into a target date fund, where essentially just, you're 40, so you're supposed to retire in, let's say, 25 years. So we're going to put you in the 2050 target date fund and that way it's just sort of appropriate for you, unless you pick your own investments. That's what your money will go into by default. So they solve for that particular problem, because then it's not just cash like the stable value option, and it's not also a sort of values assumption about whether you should be aggressive or conservative or moderate or somewhere in between. It's just based on your age, this seems roughly appropriate for you, and if you don't pick your own investments, at least you're invested in something.
Okay. Well, you touched on a little bit there that sounds like there's actively managed and passively managed target date funds, or not necessarily.
Yeah, but depending on the fund company, some fund companies offer both a passive and an active. The research on this, Sean Davies up at Seaboulder actually has a pretty good paper on this. Suggests that the passive ones absolutely crush the active ones, but that's also pretty true of the broader stock market and broader investment world. That just when you look at 10, 15, 20, 30-year performance figures, the active stuff at some point tends to trip and stumble and fall behind its passive peer. So passive tends to work a lot better. The costs tend to be a lot lower, and just generally speaking, you're also taking this human element out of it to some extent, where it really is just sort of on autopilot, for better or worse.
Right. So, broad statement, but passive is better in this regard.
That is at least our philosophy from an investment standpoint. That's also what the research suggests. But you can always find a fund that outperforms or manager that outperforms for a while. It's just a question of whether they're going to outperform for 20, 30, 40 years straight. The probability there's pretty low.
Right. But what happens? Okay, say you pick a date, you picked 2045, whatever, and that date passes. Does it just remain pretty conservatively invested until you decide to pull it out? It doesn't kick you out of it.
Well, it's going to sort of just keep going through that. Now, some fund companies then just keep the older series. So, like, there's a 2015 fund and a 2010 fund. Like, they're just for people who are retired, 5, 10, 15 years ago. Some will start to do a roll up portfolio at a certain stage. So they'll have something just like the target date income fund, where essentially once you get past your retirement years, they then convert all the shares from that fund into the other fund. And now you're just in this, like, everybody who's retired is in a particularly conservative pool. But yeah, I mean, that's the basic idea here is all things being equal, if you don't have the knowledge, experience, expertise, or have the professional help from somebody like a financial planner to more specifically allocate a portfolio for your individualized needs, plans, and timelines, target date funds are a good one-stop shop solution for the average consumer to just get something akin to professional management that's just not necessarily personally tailored to them.
Right. Which kind of leads to, okay, what are the downsides then? Is that it's not customized to your life and really factoring in things other than the year that you hope to retire.
Yeah, I mean, it's a one-stop shop item, and like all one-stop shop items, it can't be tailored to you. So you have issues of the timeline is typically done in around 5 years. Well, what if your retirement year is going to be in 23 or 28 or 33 or 47 or something like that? So there's a slight inaccuracy there. I think that's a small issue. I think a bigger issue is that a lot of them run on like clockwork. They say, like, look, when this year comes around, we are going to shift 5% from equity to fixed income, and that might be fine long term, but maybe that particular year that they had on schedule is not a good year to do that. Maybe equities are down 30% and fixed income's up 15%. And in a scenario like that, you go, okay, are we actually, just because it's on the calendar, really going to deliberately make a dumb rebalancing decision here, reallocation decision here? And then it opens up a question of whether it's going to happen guaranteed or whether there is some professional discretion happening behind it. And then this adds to tracking error issues and timing error issues and so on. So there's issues like that. And then fundamentally, again, it just isn't personalized in the sense that it cannot reflect your personal preferences and values. Maybe you don't want to be overweight to international. Maybe you don't want to have a lot of conservative assets. For example, I also think that most retirement planning guide paths for target date funds get too conservative too quickly, in that you'll have something like a large cash position and fixed income position in your 40s, and large is relative, but you'll be at like 20% fixed income cash, and I'm sitting here going, well, if you're not retiring for another 15 to 25 years, like, do we really need to have that much fixed income in cash? Do we not let it ride a little bit longer until we're maybe 10 years out or 5 years out from retirement before we start de-risking? So there's things like that where, again, the overarching theme, be aggressive when you're young, be conservative when you're close to retirement, is good. But there's just a lot of issues where I look at it on an individual by individual basis and say, this isn't a bad solution. It's just never the best solution for any specific individual.
It seems to be a reoccurring theme in today's episode.
Well, and that's sort of the thing, right? I now have a PhD in personal financial planning, and the emphasis here is on the word personal, right? It is about what individuals need to accomplish their best life goals and to live their best lives and so on. And so, in that context, the overriding question becomes when you try to use a broad brush or a one size fits all solution, the problem is that there is no one size that fits all. It just doesn't actually exist. And I think in that context, if there's anything to take away from our conversation today, it is that every lawyer, accountant, and financial planner's favorite phrase is "it depends," and there's a reason for that. It's because everything about student loans, about whole life insurance, about target date funds, whether they're right for you, the answer is always going to be an "it depends" answer, and that's what really matters most. It's not enough to just say this is a great solution, end of statement. You have to understand whether it's the best possible solution for your individualized needs. And if you have the time, energy, enthusiasm, and education to ascertain and determine that for yourself, terrific. And if you don't, please talk to a professional. It doesn't have to be us, it doesn't even have to be a financial planner. The right professional could be a tax professional, it could be a legal professional, it could be just a great friend who really understands a lot more about this than you. But if you don't understand and haven't studied these things and you don't know how to assess whether it's right for you, please get the help that you need to do the right thing for yourself, because the ramifications of doing the wrong thing with student loans, with your life insurance risk management, with your investments can equate to hundreds of thousands or millions of dollars of opportunity cost over a lifetime. And that just kills me, because everybody should have the opportunity to build wealth in their lifetime in the most efficient way possible that helps them live their best single life that they get, their best shot at it.
That's pretty good, Dan. Does that cover our, what did we learn this week? What's our big takeaway piece? That's kind of hard to top that.
No, because you already knew all of that. So I still get to put this one back on you, other than that everything is personalized and it depends and should, fundamentally be tailored to arrive at the best possible outcome for every individual. What have you learned in the last couple of weeks, Emily, that you could share with our audience?
Um, well, more recently, make sure to have really good insurance on your home, but that's less so what I've been learning at work and school. That's just from watching people I don't know. I don't know how to how deep to get into that. Um,
What Emily is pointing at is that about a quarter of my house is currently flooded and water damaged. But that could be a whole separate podcast.
right. Well, thank goodness you have good insurance. That would have been devastating otherwise. And as someone who is not yet a homeowner, that's the biggest takeaway, more than anything else I've learned, actually.
Yep. Hope for the best, prepare for the worst.
That's right. That's what you tell everyone. And it's nice to see you living it out. And not glad that your house flooded, but you're proving a point.
For better or worse. So, other than pointing at my misfortune, what have you learned in the last couple of weeks?
Oh, let's see. Well, this is where my topic pulled from the whole life insurance one is that I run into a couple people who are my age, in their 30s that have a whole life policy. And I was on a hike with one of my friends last week, and she said that her twin sister, who's also in her 30s, had one. And she kind of had said, do you think that she's getting scammed basically? Do you think this is a good idea? And I did the disclaimer of like, I don't know her and I don't know her situation, but probably. And it never ceases to amaze me how many people I know and just bump into that have all of these things, which can sometimes to me just feel like, topics in a textbook that I'm reading or something I'm doing at work. But it's interesting to see it in my personal life as well, because I tend to keep things separate in my brain. I'm like, well, this is work and this is personal, but it's all very, very tied together, which I've learned a million times over. And yet I feel like I have to keep relearning that. It's affecting everyone that I know, not just, clients at work that find me through the website and I maybe didn't know personally before.
Yeah, and it's an interesting thing because if you look at the financial services ecosystem, we live all the way, for anybody who's listening, right? We're a family financial planning practice. We are all the way on the end of a spectrum of financial services firms. Like we are all the way out there, past several standard deviations, like in the 1%, 2% category of how we approach financial planning and business. We are not the average firm. And I'm not saying that to then mean like we're above average or something. Like we're just not, we don't do business the way the vast majority of the industry does. And I say that to just point out it would be fascinating to see how dramatically investment, insurance, et cetera, recommendations would change in the industry if you took away the commissions entirely. If you just said, hey, financial professionals, you can work for Northwestern Mutual, New York Life, you can work for any insurance company, any investment company, but you will never get paid another dollar based on recommending the products of these companies. Your clients must pay you a flat fee, a fixed fee, an hourly fee, a percentage, whatever it is, but you will not get paid based on the product that you recommend. It would be remarkable to see how little permanent life insurance got sold after that moment. But so long as the commissions are enormous, so long as the premiums are that much higher, which the commissions are derived from, and so on, we are going to continue to see a world in which there's a lot more whole life insurance happening and things like that than is appropriate for people.
So it sounds like I don't have to worry about you changing our pay structure here.
No promises. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.